Okay, I'm gonna turn over the financing part to Vyrle, since we did have a change in your premiums here, as well as all the premiums for all the member counties.
Well, because the changes were as significant as they were this year, we decided, and frankly, we're making these trips a little later than we normally would because of the things that we're developing. We decided it would probably be a good opportunity to be able to go through and better explain why the increase, or what constitutes the increase, and in turn, why there's disparity amongst the members themselves. In your packet is a copy of the annual report from what now is a year ago, since our fiscal and policy year ended on September 30th. These are already a year old. But in the centerfold of that is a quick chart of the makeup of the liability program on the left on page 12 and the property program on the right on page 13. And they really have not changed, or they did not change significantly between the 07-08 year and the year that just expired. So I wanted to go through that because I can make some references here as we go through this other chart. If you'll see the beige color throughout that chart represents the amounts that the member jurisdictions are paying based upon their deductibles, or approximately would pay based upon their deductibles. And as you roll across from left to right, you can see that the $10,000 deductibles have a very small share. And as you go over to the right, you'll see the $500,000 deductible counties actually pay a very large share. Then above that on the left, you'll see the pooled area in yellow. This is a portion that the pool actually holds itself. It's the portion above the member county's deductible up to $100,000. And then, as David mentioned, the board of directors has decided to exercise a business action and purchase reinsurance for the coverage beyond that particular level. So the only portion that's really pooled is that portion that is in yellow. Claims that would exceed the county deductible but be less than $100,000. Above the $100,000 level, up to the $500,000 level, we have our first layer of reinsurance. So as I go through this chart, I want you to just keep in mind that's the first layer of reinsurance. And then the next in blue is what we have referred to as our second layer of reinsurance. That is the area where there is a significant, or there was a significant impact. That raised the coverage per occurrence from $500,000 to $10 million. Now, that is the layer from the blue down, is the portion that falls under the reinsurance, or under the pooling agreement itself. The pool self-insures jointly amongst its members the first $10 million per occurrence, subject to the the member's deductible, and then in turn, the pool reinsures everything over $100,000 that might come forward. However, if something were to happen, a reinsurance company were to default, or whatever the case might be, the policy and the membership has agreed to insure itself and its members up to that $10 million level. Above that, which is the area in red, it's called following form excess insurance. Now that's key. It's a separate policy, but instead of having separate language, it effectively agrees to follow the form of the pooling document itself. So the coverage document that the membership has made and the membership maintains, the board of directors reviews it and makes adjustments that they choose each year. The insurance companies have agreed to insure on that document. So we're not reinsuring in this case, you're buying a separate policy for those cases that might be catastrophic in nature, but you still use that same document. Now I'm going to jump up here and kind of go through this chart.
Could you say what ACE stands for on the reinsurance?
That's just actually a company. It's ACE American, ACE Public Entities is the piece that we work from. It's an outcropping of the old insurance company in North America, INA, that you may have heard of 30 years ago, 35 years ago. It's an A15 rated company, a very high level company in that particular accord that is very strong in the reinsurance room. So that's why they're stepping in. Okay, that first layer, this is from the deductibles, in your case, in Jefferson County's case, any occurrence which exceeds $10,000 in value, up to $100,000 falls into this layer. And we pool that. We don't buy insurance. That's all self-insured. And according to state law, we're required to have an independent actuary determine what the value of that is estimated to be. The expiring amount, the portion that was used in the past year that expired on September 30th, was a little over $1.4 million. The actuary said for the same coverage and the same membership, with the adjustments, slight adjustments in worker hours, we would need approximately $1.6 million for that portion. So there's an 11% increase in that layer. So since Jefferson County participates in that layer, your portion of the increase for that layer went up 11%. The next layer, which is what we refer to as a working reinsurance layer, this is the amount from $400,000 up to, from $100,000 up to $500,000 per occurrence. This is what we would typically work with as a working layer in the pool itself. Your deductible would be the county's working layer. The pool would have that layer up to $500,000. At one time, that was the retention layer. But you'll recall back that there were some bad years that the pool had, and as a result, the business decision was made to lower the retention. But regardless, that corridor amount, or excuse me, that reinsurance layer had no increase. There was zero increase there. And since Jefferson County carries a deductible below $100,000, they're participating fully in that layer. So
Is there a difference in the chart you have on the wall and the one that's in our
slightly
handout?
different, because the one on the wall is actually what occurred at the board meeting, at the annual meeting. The one that's in the packet is what the final conclusion was. And the change was, we had 3 member counties who changed deductibles. And because they changed deductibles, they participate more or less, as the case might be. So use this one, because this is what the increases pertinent to Jefferson County are based upon, or were based upon, okay? That major working layer had no increase at all, so there was no adjustment in Jefferson County's premium for that portion. The next portion, which was this $9.5 million excess of the first $500,000, as you can see, the pool had been paying a little over $2 million for the premium for that $9.5 million of the coverage. The insurer, because there were some problematic cases that developed over time that the insurer actually had to pay out on this past year, significantly to the tune of about $12 million, said, we're just not interested in continuing to serve the pool at that level. We're interested in the pool, but we're not interested in an attachment point, anything less than $2 million. So as a result, they've come in at this particular level here at $2 million attachment, and they're covering then the next $8 million to raise it up to a $10 million coverage. However, it left a void, $1.5 million void, that the pool directors had to take steps to be able to fill, and with the broker, found a couple of other companies to be able to fill in on. But the result of that is that whopping 123.8% increase for that share. Now again, all counties, all members, depending on where they attach at, have undergone these percentage increases based upon that. Those counties with a $500,000 deductibles ended up getting 123.8% increase. All counties got the 123.8% increase for that share. But some, that's only a small portion of their total premium, and others, it's their full premium. So the percentage of adjustment by member really depended on where they attach.